Now let's move on to see how the day book as well as in fact the petty cash Imprest system that we have already seen also lends itself to the double entry bookkeeping system, and we can actually enter the transactions which we capture in these books also into the ledger. So how do we do that? Let's take the sales day book. We know that the total of sales, credit sales that have been done is 4,85,000, and we have all these as debtors. So asset has increased, so debit the asset account which is your debtors account with 4,85,000, and income has happened, and then obligation to receive income has happened, and therefore the sales has happened, and we know income increase means credit the income account which is the sales account. So this is something that we can use the day book and post the transactions in the concerned ledger. Let's look at if you want a little more breakdown of the sales figure, then we can have two accounts which says sales of suit account and sales of shoe account. The debtors amount remains the same. In fact, the debtors also you can break down to Spencer, Trips and Tours, Style, etc. But just to give you the concept and understanding, we have broken down only the sales part and said that we can have two ledger accounts which says sales of suit and sales of shoes, so that also can be monitored. Otherwise, the transaction or the way you treat the transaction in terms of debit and credit remains the same. Now what happens when a return happens, when you have sold something and it has come back to you? Two things have happened. What sales you have recognized has reduced now. So as well as the debtors, the person, in this case example Spencer, who has to pay you, he has to pay you, or the firm has to pay you a lesser amount. Since the sale has reduced and income has reduced, we debit the income account with the return, and since the debtor, which is an asset, is also reduced, it will be credited with the return amount. So when a return happens after you have sold, the entries are debit sales return and credit debtors. Now purchase day book is purchases are a expense to you. So as the purchases increase, you debit the account, and in this case the purchases are 3,35,000 rupees. These are purchases for resale. Apart from that, you also have an expense of electricity bill, which is a utility account. So you will debit expense of purchase, you will debit expense of utility because both have increased, and you will credit a liability account because you have to pay them, the creditors account, with 3,50,000. So this is again journalizing or posting into the ledger the purchase day book details. The same logic which we used in sales return, when purchase return happens, you have to pay less amount, so your creditors have reduced, therefore debit creditors, which is a liability, and purchase returns means that your expenses have reduced, and therefore you credit the purchase return accounts. So the same logic is applied. Let's see how to the petty cash Imprest system the nominal ledger system can be applied. So when initially we transfer from the bank to the branch office, say 5,000 rupees for miscellaneous expenses which are known as petty cash expenses, what has happened? Petty cash account has gone up. It is an asset account which has gone up. So debit petty cash, the bank cash balance has come down. So credit bank of with rupees 5,000. Thereafter, if you look at the petty cash book, during the month we had expenses of various kinds. So these expenses are to be debited because expenses have increased. So the entry would be debit your courier, your refreshments, local conveyance and other expenses with the respective amounts, and since you are paid out in petty cash, from the petty cash account you are paid out, the petty cash is an asset account which has come down, credit petty cash, the total of the whole thing as rupees 925. Now within the petty cash Imprest system, we know that every day, suppose the minimum balance to be maintained is 5,000 under the Imprest system, then whatever expenses have happened, that needs to be topped up. This is something that we have already discussed. So what happens in that situation? We now transfer the amount of expenses that we have already incurred. So we debit petty cash, which is an asset account which goes up, and where do we transfer it from? From the bank, and therefore the bank balance comes down, which is an asset account which reduces or decreases, and therefore credit cash at bank with that amount. So this then adds up to the petty cash, and the petty cash account now will show a balance of 5,000, because here you see the balance that we brought down was 4,025 after the expenses, and on the next day 925 of cash was transferred, so that under the Imprest system the 5,000 rupees balance is maintained. And if you look at the petty cash ledger, it will look like this. Initially 5,000 rupees were brought in, so increase is debited to petty cash. Then there were payments, which is a decrease in petty cash, so they were credited. Then the balance for the next month has to be carried down. Before that, a cash transfer was made, which means increase in petty cash, and therefore they're debited, so that we have the 5,000 rupees carried forward under the Imprest system for the next day's operation or next month's operation, depending upon the system, Imprest system that is followed, a monthly Imprest system or a daily Imprest system. So that tells us that how the double entry system pervades all across. Basic accounting is focused purely on the accounting equation and double entry system, and this double entry system of accounting is achieved through journal entries as well as ledger entries. And we also seen now how the books of prime entry also lend itself to the double entry concept, and how ledger accounts are maintained. So this kind of brings us to a very important situation where we will now move on to see from where on from the ledger how we move on to the next level of financial statement generation, which is what the next topic as we go along will be.